Congratulations! You are now officially an investor. And by watching this video, you have officially started your investment journey. And hopefully, because of this video, you're no longer going to have to be a Walmart greeter at 70 years old. And now that you're here, you might be able to retire on a beach somewhere, maybe like in the Caribbean, sipping on a nice martini or margarita, or really whatever drink you prefer. There's so much that goes into investing, so I'm not going to overload you with a bunch of information, especially because you're just getting started. What I want to do for you is simplify everything and put it into a video that's 20 minutes or less. This is the best guide that I could possibly put together, and I asked a bunch of people of their advice on what I should include and what I should take out. So these are the best little tidbits that I have for you guys. And welcome to the Investing 365 channel. If this is your first time here, welcome. And if it's not, welcome back. Don't forget to smash the subscribe button. And if you like content like this and you want to see more stuff like this, hit the like button as well. And without further ado, let's jump right into the step-by-step guide on how to invest for the first time ever. Okay, there is a lot of information to unpack here. If you want to get the most out of this video, I would honestly start by getting out a sheet of paper and maybe a notepad or like a pencil or a pen and just writing everything that I say down, almost like a to-do list or a goal sheet. But science has shown that if you write things down, you're going to be able to digest them better, and you're actually more likely to do those said things rather than just thinking about them and then completely forgetting about them, almost like in one ear and out the other. So what most people are going to tell you is just to take your money and throw it in the stock market, whichever way the wind blows, and you'll be a millionaire. But in this video, I want to teach you a formula that will allow you to build the confidence to being a successful investor from day one. So first and foremost, what I tell everybody that asks me, hey, I want to start investing, where should I start? What companies to look at? What brokerage, etc., etc., etc. And I tell people, always start with your why, because if you know your why, then you have something to work toward. And if you already know your why, bear with me for a couple seconds because I want to share this with people that don't know. Think about your why as a mission statement, your life goal. The way I've been able to break this down for people is which of these freedoms is most important to you. Maybe it's the freedom of your time, or AKA early retirement. 2 could be your money, pretty much being able to buy whatever you want. Number 3 is freedom of relationships, which is the ability to spend time with anyone. And 4 is your purpose. Usually this is something that is greater than yourself. Maybe starting a charity, a school, whatever it may be. So this is kind of an individualistic question, but it'll allow you to think about money on why you want to amass a certain amount of wealth. And if you know that, that will allow you to define how much money you actually need. If you have the why with the right amount of patience, resilience, and execution, that third one is the most important one, I am sure that you can get to the destination that you want to go to, whatever your goals may be. So now feel free to pause the video right here and write down your why. Maybe think about it for a moment. And like I said, you can always come back to this video if you subscribe and like this video because it will be saved in your history. But let's move on to the next step, and that is to be able to invest in a risk-free way. And so what do I mean? I don't mean taking your grandmother's money and investing that because technically that money isn't yours. No, what I mean by that is starting a brokerage account with a financial institution that allows you to play with fake money. Now, this is just option number 1, and I don't recommend this for everyone because some people just want to get their foot in the door and they're ready to go. Maybe they have a few $1,000s laying around and they just want to put it to work. So option number 2 for someone like that would be to take $100 or so and to put it into an account with a brokerage that you trust. And I have a couple links down in the description below of some of the brokerages that I use. I use M1 Finance, Stash, Robinhood, and Webull. I use all 4. So you could actually open up an account with each one of these if you're first starting out, and they're actually gonna give you some money just for your first deposit. So once you deposit like $100 on each platform, they're just gonna give you free stock or free cash. You can take that money and whatever brokerage you like the most, you can take that money and you can put it in your favorite one and pretty much get free money this way as well. But the first method is really useful if you want to start investing without any of the losses or the painful mistakes. Honestly, in my opinion, I think that the mistakes are very, very important. And if it weren't for those painful mistakes, I probably wouldn't be in a position that I am in today. But remember, if you do end up picking the right stocks and making some serious gains in your portfolio, and you went with option number 1, those gains aren't real either. And sometimes that is a really, really painful pill to swallow. So once you think you're ready, you can move on to the next step, which is just step number 2. So if you did go with the free account, go to opening up a small account on one of these brokerages, or try them all out just to see which one you like most. And then once you have one that you really are dedicated to and you feel like that one is just right, you can put all the money that you have or want to invest into that account and slowly start buying in. Now you might be wondering, what stocks do I buy? And what the heck are PE ratios and market caps, the Fibonacci or the MACD? How do I know the industry size, the quarterly earnings, the balance sheet, maybe long-term or short-term debt, or really what do I need to be looking at? All this investment jargon is just meant to confuse you. And to be honest with you, for the first few years of my investing career, I had no idea what most of these things are. I just started putting money into stocks that I was familiar with and that I enjoyed using their product, right? So this was a really easy way of getting started. And it might sound like an oversimplified version of what investing might really look like, but in my opinion, that is the best way to start, because a lot of people go in with the mindset of, I'm gonna learn absolutely everything there is to know about investing and then I'll start. And at that point, well, this could be 5, 10, 20 years too late. Their portfolio could have been worth hundreds of thousands or if not millions of dollars had they just started and maybe made some mistakes along the way. Now their portfolios are only worth maybe tens of thousands of dollars. Sure, they're not making as many mistakes, but they've also missed out on some insane gains that they could have had just being in the market. But so I want to share with you the oversimplified version because I think this makes the most sense. And honestly, there's a bunch of ETFs, which just means exchange traded funds. Again, none of the fancy jargon. It's pretty much just a combination of stocks in one portfolio that you could buy, and you're buying little tiny fractions of each of that company that's within that fund. So the next step that I say is finding one that you have an extreme knowledge about already. So if you like playing video games, guess what? There is an exchange traded fund for you. If you like cars, guess what? There are automotive companies all over the world that you could invest in. Maybe you work at a pharmaceutical company. Guess what? There's a bunch of pharmaceutical companies that you can invest in. If you work for Kroger, guess what? Kroger has a stock. If you work at McDonald's, guess what? McDonald's has a stock too. Literally, think of a company that exists and guess what? It probably has a stock. Now, not every company is available to be purchased. Some of them are private. So that is something that you might have to look at. If you type in the name of the stock on a brokerage account like Robinhood or Webull or any of these other ones that I mentioned before, and the name comes up and it says buy, guess what? You can buy that stock. So if you're familiar with these particular companies or this industry, you can go ahead and buy the stocks themselves, or you can just type in on Google ETFs that include XYZ or ABC or whatever the ticker symbol is, McDonald's, Walmart, Amazon, Tesla, any of these companies. If you type in ETFs with these companies in them, guess what? You're gonna get a search result with exactly your inquiry. And there you go. You have your very first investment decision. A really big important thing to remember is that now that you bought this stock or this position, right, this ETF, whatever it may be, remember this piece of advice because it will help you so much. A lot of people get stuck in the price and the volatility of certain companies or certain ETFs, but the biggest thing, if I can get you to take anything away from this video, is to be emotionless to the actual stock price. So many beginner and even intermediate investors will look at the stock price and make their decision, investment decision, based off that price. Maybe it's too expensive. Oh, this stock is cheap. I'll buy it because it's $2 a share. Or maybe it's $700 a share and I don't want to buy it because I can't buy a whole share. Most brokerages will actually allow you to buy what's called fractional shares. So if the stock goes up 10%, the 700 stock that you picked out goes up 10% and you only threw in $100, guess what? Your $100 will still go up 10%. It doesn't change. And that's what you need to be looking at, not the particular stock price. Cheap stocks are usually cheap for a reason, and expensive stocks usually are the ones that outperform the market. It's really important that you remember this and try to keep a mental note that the intrinsic value, the actual value of that company or that stock never lies with the actual price that that stock currently has. The intrinsic value is actually more complicated than that. I'm not gonna get into that in this video, but it does have something to do with the market cap, the PE ratio, and a bunch of other factors that you can look at to get an actual intrinsic value. But like I said, if you could take one thing away, and that is some of the biggest companies that I see people missing out on are like Google and Amazon and Facebook. They think that these companies are super overpriced when their intrinsic value in a lot of cases during the whole entire of the market, that their stock price versus their intrinsic value actually has been lower. So here's the stock price and here's the intrinsic value. The intrinsic value is up here, right? They're gonna make more and more money year after year after year. Meanwhile, the stock price is down here. But what a lot of people see is actually the opposite. They see an expensive stock price and they think that the intrinsic value is down here. So why would I want to invest in something that's overpriced, right? So take that out of your head right now. Don't look at the price at all. Be completely emotionless to this fact, and that will help you become a more savvy investor right out of the gate. The next thing I'm gonna tell you is that you need to be conservative at the beginning. Putting all of your money into the market all at once is really, really reckless, especially if you have like an inheritance or a trust or just a big lump of some money that you had it's sitting in a savings account. It doesn't really matter how you got it, even if it's maybe, not the most legal way. I'm just kidding. But on a serious note, setting aside small chunks into the portfolio or into a particular stock is the best way to go. And this is called buying over time. And if you want another piece of advice that most people won't tell you right out of the gate, is if you can get into that habit of buying over time, but when you see the stock price drop 5, 10, 15%, as long as this company is performing really, really well and has a really bright future ahead and all these metrics are met and you're familiar with them, maybe you use their product, all those boxes are checked in your own head, guess what? If that stock price drops 5, 10, 15% and you're emotionless, you're just like, I'm just gonna keep buying and buying and buying. It doesn't really matter what the price does. If you can take that a step further, you will be leagues ahead of everyone else in the world of investing, maybe even Warren Buffett, because the next step that you could be doing is doubling down on those investments when they drop in price. What do I mean by this? Well, let's say the whole economy crashes 30% overnight because of something like a pandemic, kind of like what we had in March of 2020. If that were to happen and you're already emotionless, right? You've been practicing this for maybe months, or maybe years, and you happen to see this and you've been emotionless throughout this whole time and you see this big drop, you will actually see this as an opportunity rather than a loss. And you can double down on your investments. So let's say you have $1,000 just laying around and you're usually only putting like $50 into the market per week, and you see this crazy drop. That is your chance to double down on the stocks that you believe in. And historically, what the market has shown us is that bull markets continue right after bear ones every single time. And so hopefully we don't ever have that where, a bear market just continues and continues and continues, or even have a market that just goes sideways for a long time. Historically, so far, we've only had bull markets after bear markets every single time. So that's really important to remember. And if you can double down during these highly irrational times or really, really skeptical times, you will be a much, much better investor. All right, I'm gonna take you another level up, and that is to remember that risk equals reward. But it goes without saying that too much risk can also equate to a lot of pain if you take the wrong risks, right? And so the most common way to reduce the risk, not completely remove it, but to reduce the risk, is to try and diversify into multiple companies in different sectors. And you can even take this one step further by perhaps buying different asset classes like precious metals, like silver, bonds, real estate, cryptocurrencies, all of these things that have the potential to grow over time. That will help you stay diversified, and typically it will also reduce the risk and maybe even bring in a higher reward, because if you didn't invest in silver when the price is 12 and it went up to 28, meanwhile the stock market went sideways for a little while, you missed out on those gains. The same thing can be said vice versa. So remember that. Stay diversified, it will lower your risk, and it also might give you some gains when everyone else is panicking. This next lesson is really, really important. Get familiarized with your company's competition. So if you're betting on Tesla, get familiarized with the products and services that Toyota, Volkswagen, Nissan, all these other car manufacturers offer, because if they're catching up in technology or have something better coming out soon, that might drive the price down, and you don't want to be stuck in that trap of getting hit by that bullet train that you didn't even see coming. So at least get familiarized with the competition that the companies that you're invested in are going up against. A really easy way to think about it is think about it like teams. A good example of this is think about Tesla playing for the EV squad. Meanwhile, Ford is playing for the old school combustible engines team. And remember, this is just one example. There are countless other examples. Okay, so if you think about investing like you're putting your money to work for you, this should actually be a pretty fun process, because it's like having a second job that's not really a job, right? You're not working, your money is doing the work. You're just kind of guiding it to the right investments, and then those investments grow on their own, your money grows with them, and then you can take out some of the profits and do the same thing, kind of rinse and repeat, right? And honestly, if you're finding your investing journey becoming more and more stressful as time goes on, you might actually just be a passive investor. You don't need to be as active as you're being. So don't make it boring. Have fun with investing. It should be a lot of fun. And every single time you look at your portfolio, whether it's down or up, it should be an exciting moment. If it's going up, that's obviously good. And if it's going down, those are buying opportunities that you can have right now in this moment, that next week or next month or maybe even next year, the portfolio is going to go up and up and up because of the decisions you made today. Remember that. And an easy and fun way to make it more enjoyable, but also have the accountability behind it, is to involve your friends and your family members. A good way of doing this is not by telling them to buy call options or put options or just getting into the market with all their money. Like I said, it's important to start the same way that you did, where safety and risk management is involved. Have them watch this video, go send it to a friend that might just be starting out on their investment journey, or maybe someone that has already started, because there may be something in this video that they might have overlooked. And as you probably know, getting back to the basics is the biggest thing that you can do for your portfolio in the long run. A lot of people try to get complicated and, like I said, look at Fibonacci's and they hyper analyze exactly when to buy a certain stock, and then they miss out on extreme gains. And it's okay if you don't have a lot of friends or family to be investing or sharing your investment knowledge with. We're not all that fortunate, I get it. So that is why I started a Discord group not too long ago, just on January 1st of 2021. So at the beginning of the year, I started a Discord group for you guys. So anyone at any investment level, whether you're a beginner, intermediate, or an expert investor, you've been in the market for 10 plus years like I have, you can actually be a part of this group for absolutely free. I'm not trying to sell you a course. I'm not trying to sell you anything. There is a paid version of the group. I want to be completely honest with you. There is a paid version of the group, but the free one is available to anyone, right? You don't have to have a lot of money to be a part of this. And even the paid one is only around $10 per month. So super affordable. Remember, that's just 2 lattes a month, and you could be getting a lifetime of knowledge just in one group. Remember, 2 heads better than 1. But when you have a lot of heads brainstorming and putting all their investment knowledge together, you have tens of years, if not hundreds of years of experience under one roof, which is this Discord group. The link is down in the description if you want to go ahead and join that. If you enjoyed this content, it would mean the world to me if you just smash the like button and hit the subscribe button. And if you want to be the first one to see videos like this every single time I post, go hit the notification bell as well. Feel free to check out the links down in the description below, where you can get a free stock from Robinhood, $20 free from Stash, 2 or more stocks free from Webull, or $10 free from M1 Finance. I'll see you guys in the next episode. Peace out.